Hey guys, what's up everyone? Eric here, Mr. Fired Up Wealth, and I have an exciting video for you today. When trying to think long-term about your stock portfolio, it's important to think outside the box to ensure growth and outperformance. I am always thinking about growth trends and thinking about companies that can benefit from these growth trends. Fringe plays can be an excellent way to benefit from a secular growth trend without investing directly in that sector. One of the largest secular growth trends of our generation is and will continue to be legalized and recreational marijuana. Maybe you don't want to invest in Aurora Cannabis and Charlotte's Web. Maybe you're a pure dividend growth investor who simply can't justify high-risk companies with rich valuations. Maybe you already own pot stocks and you want to diversify outside of the sector. Or maybe you just simply don't invest in sin stocks. How can you try to capitalize and not invest directly in pot stocks? I have a great solution for you to consider. Today, we'll discuss blue chip companies that don't sell any pot, but reap benefits as legalized marijuana expands. A recent survey from addictions.com provides excellent insight into what people like to eat when the munchies strike. I've used the results from the survey to put together a solid list of DGI stocks. I'll be covering 10 established blue chip dividend growth investing stocks, as well as several bonus picks at the end, so please stay tuned. I'm really excited about this video. I'm excited to share these picks with you, so let's get started. Number one on the list is Papa John's Pizza. Yes, pizza. Of course, pizza needs to be on this list. Papa John's stock is a pure pizza play, and everyone loves pizza, especially when they're stoned. And I love the fact that Shaquille O'Neal is a store owner, and now he sits on the board. They're even running a Shaq commercial campaign this NFL football season, which should definitely make an impact. The brand is trying to recover from some very bad press relating to the company's founder, who unfortunately made some derogatory racial remarks and has since been ousted from the company, the founder. Shaq is a perfect person to help the company recover. Everyone loves the guy, they just do. Pizza restaurants and marijuana also go well together. You may recall Peyton Manning, who was quarterback for the Denver Broncos. When he played for Denver, he actually opened several Papa John's stores prior to Colorado legalizing recreational marijuana. I'm not sure if you realize that or not. He's a smart guy. This was a brilliant move, and the numbers definitely seem to show a strong correlation. Papa John's pizza quality has improved dramatically over the past year or so, and I encourage you to try it if you haven't recently. Try their thin crust, extra sauce, square cut. It's actually pretty good. I'm not saying it's the best pizza in the world or anything, but I like the company and the stock. Papa John's has 5,200 establishments. 4,456 are franchise restaurants operating domestically in all 50 states and in 44 countries and territories. Papa John's operates 246 company-owned stores under joint ventures and 35 units in Beijing and North China. The stock ticker is PZZA, and it pays a 1.8% dividend yield. They have increased their dividend payouts every year for the last 5 consecutive years. Take a look at Papa John's, stock ticker PZZA, as a long-term DGI play. I think they could benefit from this secular growth trend, and it's one you should take a look at. Number 2 on the list is Pepsi, stock ticker PEP. Think snacks. Pepsi owns Doritos, Lay's, Cheetos, Ruffles, Fritos, Sun Chips, Cracker Jack, Captain Crunch cereal, Matador beef jerky, Funyuns, Roll Gold pretzels, Quaker granola bars, and even Grandma's cookies. These are popular munchie foods, and Pepsi could definitely reap benefits from the long-term trend. It's a well-run company with excellent diversity compared to Coca-Cola. It pays over a 2.75% dividend yield, and they have increased their dividends annually for 46 consecutive years. Number three is McDonald's, stock ticker MCD, which is the second most popular fast food place to visit for people surveyed, behind Taco Bell. There's a lot to like about the company and the stock without legalized marijuana as a potential growth driver, but it certainly can't hurt. Think about it, McDonald's is everywhere. If the US legalizes federally or even continues to expand legalization and societal adoption, McDonald's has a restaurant practically on every corner just waiting to serve customers with the munchies, not to mention global adoption. McDonald's has restaurants found in 120 countries and territories around the world, and they serve 68 million customers every single day. McDonald's operates 37,855 restaurants worldwide, employing more than 210,000 people at the end of 2018. They also recently have made huge improvements to technology and operations, and they've overhauled their entire menu. My younger friends tell me it's now a hip place to go, which was not the story even 5 years ago. MCD pays over 2% dividend yield, and they have increased their dividends annually for 42 consecutive years. Number 4, cereal is very popular according to the survey, and several of the favorite brands are owned by General Mills, stock ticker GIS, who produces Reese's Puffs, Lucky Charms, Golden Grams, Count Chocula, Trix, Cinnamon Toast Crunch, and Cheerios, as well as a ton of other non-cereal brands like Nature Valley Granola, Yoplait Yogurt, and Haagen-Dazs ice cream. Many others as well. As a side note, I like their pet food brand called Blue Buffalo. My wife and I were part of the initial public offering, or IPO, of Blue Buffalo a couple years ago, and General Mills acquired the company in 2018 for a whopping $8 billion. This worked in our favor because General Mills paid a premium, paying $40 a share, so we were quite happy. GIS also pays a 3.57% dividend yield, and they've had dividend growth annually for 15 years and counting. While we're on the topic of cereal, number 5 is Kellogg's, stock ticker K, who owns other favorite brands such as Rice Krispies, Cocoa Krispies, Fruit Loops, Frosted Flakes, Pop-Tarts, and even Eggo waffles. Lego my Eggo. Any Stranger Things fans out there watching? K pays over a 3.5% dividend yield, and they have had 14 years of consecutive annual dividend payout increases, which is pretty good. As a random side note, Kellogg's also recently, just a few days ago, announced a competitive product to be on meat in the meatless space, and they called it Incognito. I'm not kidding. It's called Incognito. I'm not sure about the name, but meatless is a hot topic, so perhaps there is an additional growth driver in the future for them. They just announced this a couple days ago, like I said, so it's hard to know at this point, but it's something I thought I'd bring up. Very interesting. But check out Kellogg's, stock ticker K, as a good DGI play. Number 6 on the list is Mondelez International, stock ticker MDLZ, who owns Oreo, Nabisco, Ritz Crackers, Chips Ahoy, Cadbury, Milka Chocolate, Toblerone Chocolate, Wheat Thins, Trident Gum, and even Philadelphia Cream Cheese. This is a solid company. I originally was going to do a top 5 video today, but I couldn't keep this one off the list, so I made a top 10. In hindsight, 10 is the right number. I think you'll really like these next 4 picks, so do stay tuned and watch those. Morgan Stanley and other analysts have recently upgraded Mondelez, and most are saying it's still undervalued. I'm not sure if I agree. It's run over 35% year to date, but it is on my radar. I have a couple friends that own the stock. They pay a 2% dividend yield, and they've grown their dividend increases for 5 consecutive years. Next is Hershey, which owns Reese's Candies. Reese's Peanut Butter Cups were actually ranked number 1 on the Stoner Foods poll for candy bars with just under 25% of all votes. They also, of course, own the Hershey's Kisses and chocolate bars, but also Twizzlers Licorice, as well as the Jolly Rancher candy line, if you're familiar with that. They're also licensed to produce Cadbury products, as well as the Kit Kat bar and Rolo candies, which are both owned by Nestle. Hershey's pays just under a 2% dividend yield, and they've increased dividend payouts for 9 years consecutively. Time for more pizza. You saw this one coming probably. Domino's Pizza is the 8th stock on the list. Same with Papa John's. They have a strong reach, and continued legalization should see an uptrend over time. Their stock ticker is DPZ, and they've increased their dividends 5 consecutive years, the same as Papa John's, but Domino's pays a lower yield at 1.10%. Some people may actually prefer the stock over Papa John's, though, because of their size and scale. In fact, Domino's has over 3 times the amount of stores and nearly twice the number of countries. Domino's stores across the globe sell an average of 3 million pizzas a day. They operate 16,300 stores in more than 85 countries around the world. As of Q2 2019, Domino's estimates it has more than 400,000 franchise and corporate team members worldwide. That's a lot of employees. They also have continued to be pioneers really in the technology adoption. If you remember a few years ago, they really pioneered the whole app online to see when your pizza's being made and kind of give you an update. That was really cool. And now they've been working on autonomous delivery, robotic delivery, autonomous cars. And it makes sense being located in Michigan by the big car manufacturers like Ford and GM. They did lose their rock star CEO, if you recall, last year in 2018, Patrick Doyle, who did a great job for this company. Because of that, investors did lose some confidence. The stock hasn't been doing as well. But I do think that the company is pretty solid in long term. I think there's a lot of potential there. I also think that their new CEO, Richard Allison, seems very capable. Take a look at Domino, stock ticker DPZ, as a long-term play in your portfolio. Darden Restaurants, stock ticker DRI, is the 9th pick. Now they pay over a 2.75% dividend yield, but they've only grown their dividend for 2 years, which is why they're towards the end of this list. Darden does own some of the most recognizable and successful brands in full service dining though, including Olive Garden, Longhorn Steakhouse, Cheddar's Scratch Kitchen, Yard House, The Capitol Grill, Seasons 52, Bahama Breeze, and Eddie V's. A couple of these, I've been told, are excellent destinations when the Munchies strike. I'm not sure. This is a solid pick, though, to round out the list and to include full-service dining. Darden is a well-managed company. It has some terrific brands. I would take a look at stock ticker DRI as an excellent dividend play in your portfolio. Okay, guys, thanks for sticking with me this long. Final pick, but then I do have some bonus picks, so please stay tuned. You want to check those out. Number 10 on the list is Yum Brands, which owns Taco Bell, KFC, and Pizza Hut. Now, Taco Bell was number 1 on the fast food location list for people with the munchies to visit, according to the recent survey from addictions.com. So I really had to include it. It makes sense. I mean, tacos, nachos, cheesy goodness, you know I'm making you hungry, right? But Yum pays just under a 1.5% dividend yield. However, the problem is they've only had dividend growth for 1 year, and the overall dividend growth record for the stock has been below average, not really that great, which is why it's 10th on the list. Like I said earlier, though, Taco Bell was the number 1 fast food choice for Munchies. So, I mean, Yum had to be included. There was no way around it. I do think it's a good company. I feel like we should see stabilization in the dividend growth long term. They also own KFC, which now serves Beyond, which is, you know, another potential growth driver for the company. Take a look at Yum Brands, stock ticker Yum, as a dividend stock in your portfolio. Okay, guys, you ready for some bonus picks? The first bonus pick is Nestle, which pays a 2.15% dividend, although they haven't grown the dividend payout recently, so it didn't make the list. It's also a non-US company, so the stock is an ADR. I think it's a good company to consider for your dividend portfolio of non-DGI. They also own Perrier water, which I have a crazy addiction to. The second bonus pick is not DGI. It actually pays 0 dividends, which is why it's also not on the list. But Post Holdings, stock ticker Post, P-O-S-T, is the owner of cereals like Fruity Pebbles, Honey Bunches of Oats, and Raisin Bran, all of which made the Stoner Favorites list. Fruity Pebbles was voted number 1 on that list for cereals, so I had to include the stock as a bonus pick for you guys. You can also take a look at other non-dividend stocks in this space like Denny's, Red Robin, Shake Shack, and others. There's a lot of different plays out there that could be fringe plays. Obviously, outside of the restaurant space, there's other fringe plays as well, like Constellation Brands and Altria and things like that. There's a lot of scrutiny right now with Altria, stock ticker MO, so be a little careful with that one. I do own a portion of that because it's a high dividend paying stock. You know, they're investors in Juul, and Juul's having obviously some issues right now with the vaping. So be careful with that one, but those are some other areas that you consider that are fringe plays in the marijuana sector. Okay, guys, so this video was really fun to make. It actually took quite a bit of time to put together. I hope you enjoyed it. I know before I end, I want to say this. I know some people are probably going to comment saying something like the Munchies won't move the needle for a huge company, a blue chip company like this. I'm not saying that, you know, this secular growth trend is going to turn these specific stocks into massive growth stocks. I'm not saying they're going to perform like pot stocks or anything like that, but these are all solid, well-run businesses, and the majority are dividend growth stocks that should have some beneficial impact from the sector. The secular growth trend simply helps paint a positive long-term picture for investors. The demand should continue to grow, and perhaps at a slightly higher pace because of the fringe benefits. I wanted to create something unique and creative, so I hope you enjoyed this video. I like to think outside the box. Hopefully this helps, maybe with some ideas that you didn't have before. Thank you for watching. If you enjoyed the video, please subscribe by clicking the red button below. There's also a little bell. Please click that bell. That will make sure that you're notified when a new video is released. I'm actually releasing a top 10 pot stocks video very soon, so please stay tuned. Keep an eye out for that one. It'll be one of the best, if not the best videos that I've ever made. I'm looking forward to it. I'm excited. There's been hours and hours of research into that one. I hope that you subscribe so you can stay tuned. Thanks again for watching. Appreciate all your guys' support. Have a great rest of your day.